Hello and welcome to Energy Insights. Today we have a very special episode covering the OPEC market overview for the month of April and March related data. So in this episode we will look into the recent report published by OPEC. OPEC, Organization of the Petroleum Exporting Countries, normally termed, is a group of oil-producing nations that coordinate their petroleum policies to stabilize oil markets and ensure fair and stable prices for producers and consumers. OPEC was founded in 1960 and includes a major oil producer like Saudi Arabia, Iraq, UAE, Kuwait, Iran, and others. Some other countries are also producing crude, but they are not the members of OPEC, and they are termed as non-OPEC oil producing countries. There is a declaration of cooperation between the OPEC and non-OPEC oil producing countries, which is called Declaration of Cooperation, and normally DOC. DOC was framed in 2016 to enhance coordination in the global oil market. The most important non-OPEC partner in the DOC is Russia, along with other participating producers like Kazakhstan, Mexico, and others, depending on the agreements. So the purpose of the DOC is to coordinate production policies between OPEC and non-OPEC producers, balance the global oil supply and demand, and reduce extreme price volatility and support the overall market stability. In today's episode, first we will have to look into a very special article given in the OPEC monthly report, and then we will go through the market data on both the supply and demand sides from the OPEC as a source for the month of April and March. So starting from the segment 1, which they related the review of the special article given in the report. This article is related to the global oil demand surges into the summer 2016. Strong non-OECD growth meets tight refining system. This is the overall crux of the special article. Further, this article covers that the global oil markets are heading into the summer of 2026 with strong demand momentum, but beneath the surface, the tightening refinery dynamics and regional imbalances are setting the stage for potential volatility. Global oil demand is projected to grow by a healthy 1.4 million barrels per day year-on-year basis in 2026, with nearly all of this growth coming from the non-OECD economies led by China and the broader Asian region. While the year started stronger with 1.5 million barrels per day growth in the first quarter of 2026, a temporary slowdown to 0.9 million barrels in the second quarter, largely due to the Middle East uncertainties. It's expected, however, this softness is short-lived, with the demand rebounding sharply to 1.6 million barrels per day in the third and fourth quarter of this year, just in time for peak summer consumption. When we break it down by fuels, the summer demand story becomes even clearer. Transportation fuels are leading the research. Gasoline demands expected to rise significantly during the third and fourth quarter, and expected that 0.6 million barrels per day growth will be observed. Similarly, jet kerosene demand is also expected to climbing by 0.4 to 0.5 million barrels growth in the second half of this year, reflecting strong recovery in the global air travel. Demand for the diesel will remain steady, with the gradual gains reaching to 0.2 million barrels per day by the fourth quarter, supported by industrial and freight activity. On the regional front, OECD demand remains relatively subdued. The OECD America shows moderate growth, particularly in the second half, while the OECD Europe mostly stays flat. In contrast, OECD Asia Pacific continues to weaken, slightly reflecting structural efficiency gains and energy transition. The real engine of the growth remains the non-OECD world, particularly China continues its steady expansion, adding around 0.2 million per day each quarter, supported by mobility and industrial resilience despite electric vehicle penetration and trade uncertainties. Other Asia will accelerate sharply, reaching by 0.4 million barrels per day growth in the fourth quarter, while additional contribution will come from Africa, Latin America, and the middle distillates. India will show robust growth, rising to 0.3 million barrels per day by the fourth quarter. However, on the supply side, the critical development is unfolding in refining. Global refinery throughputs dropped sharply in the March to 77.1 million barrels per day, marking the largest monthly decline since April 2020. This represents a 5 million barrels per day drop month-on-month basis and 4.1 million barrels lower year-on-year, driven by the geopolitical disruptions, particularly in the Middle East region, and the seasonal maintenance, which typically peaks during this period. This sharp reduction in the refinery runs has already translated into tight product supply, pushing refining margins and crack spreads significantly higher, especially for the middle distillates. In response, the U.S. refiners are ramping up operation, increasing intake by 380,000 barrels per day in March, aiming to capitalize on strong margins. However, most other refiners are still lagging due to the ongoing constraints. Looking ahead, the combination of rising summer fuel demand, reducing refinery output, and tight product inventories, it's expected to keep refining margins elevated throughout the summer. In particularly, the stronger gasoline demand surge during the peak driving season, along with the rising jet fuel consumption. The bottom line is that the summer 2026 is shaping up a classic case of strong demand meeting constrained supply with non-OECD growth driving consumption and refining bottlenecks amplifying price and margin pressures. This concludes the first session, and now we have to move into the segment 2, which will cover deeply the market analysis for this month. There will be a large of data, so don't be bored with that. This is important for the analysis. So this segment will cover the various aspects of the monthly report, the crude oil price movements, then the supply demand side, the tanker market, and the product market, and then the market balancing, etc. So starting from the crude oil price movements, in March the crude oil benchmarks recorded a strong upward rally across all major grades, driven by tightening supply conditions and rising market uncertainty. The OPEC Reference Basket is increased by sharply $48.46 month-on-month basis, averaging $116.36 per barrel. Similarly, international benchmarks like the Brent front month contract rose by $30.23 month-on-month basis to $99.60 per barrel price, while the WTI price per barrel increased by 26 cents to $26.48, and it settled at $91 per barrel. In Asian markets, the GME Oman posted the strongest increase by jumping $56.14 month-on-month basis, averaging $124.56 per barrel price. The Brent WTI spread widened by $3.75 per barrel, reaching an average $8.6 per barrel, reflecting a stronger Atlantic basin pricing relative to the US crude. At the same time, forward structures across ICE Brent, WTI, and GME Oman steepened significantly, with futures curves moving deeper into the backwardation, signaling immediate supply tightness and stronger near-term demand expectation. Market sentiments also shifted decisively to bullish. Hedge funds and money managers increased net long positions as supply disruption and the rising prices reinforced expectation of a tighter physical market balance. Similarly, the world economy and the projected growth remains stable compared to the previous assessment, with no revision. The world economy is forecast to grow by 3.1% in 2026 and 3.2% in 2027. The country level forecast also remains unchanged. US expected growth is 2.2% for 2026 and 2% for 2027. The Eurozone 1.2% growth for both 2026 and 2027. The Japan expected growth is 0.9% for the 2026 and 2027. Similarly, China steady at 4.5% for both 2026 and 2027. Overall, the stable macroeconomic outlook continues to provide supportive backdrop for the oil demand. On the demand side, the global oil demand forecast remains unchanged, with growth expected at 1.4 million barrels per day in 2026, driven primarily by non-OECD countries. The OECD is projected to contribute only 0.1 million barrels per day, while the non-OECD adds around 1.3 million barrels per day, highlighting the continued dominance of emerging economies. For 2027, the global demand is also expected to grow by 1.3 million barrels per day, while the OECD contributing 0.1 billion barrels and the non-OECD accounting for 1.2 million barrels among this 1.3 million barrels. The structure of demand growth continues to be anchored in Asia, particularly mobility, industrial activity, and transport fuel consumption. On the world oil supply side, the non-OECD liquids supply growth remains unchanged at 0.6 million barrels per day in 2026, with similarly growth expected in 2027. Key contributors include Brazil, United States, Canada, Argentina, while in 2027 additional support comes from Qatar alongside existing producers. In March, the crude production from the DOC participating countries fell sharply by 7.7 million barrels per day month-on-month basis, averaging 35.06 million barrels, reflecting a shorter-term production adjustment based on the market condition and output management. In product market case, the refining margin strengthened significantly across all major regions in March, supported by tight product availability and strong middle distillate cracks, which reached multi-year highs. The market was further pressured by trade disruption and refinery run cuts, particularly in the east of Suez region during peak maintenance season. As a result, product prices increased faster than the crude feedstock costs. The tanker markets, the dirty tanker markets reached record levels high. The VLCC, the very large crude carriers, rates rose by 34%, Suezmax rose by 104%, and the Aframax rose by 68%. In case of clean tanker prices, 86%, the west of Suez routes fare raised. Similarly, the west of Suez routes increased by 54%. In case of the commercial stock movements, the crude stocks stood at 1,366 million barrels, while the total product stocks were 1,460 million barrels. For the OECD, forward cover increased sharply to 62.5 days, indicating relatively balanced but tightening market environment. The overall demand for the DOC crude remains unchanged at 42.9 million barrels for 2026, representing a growth of 0.6 million barrels in comparison after 2025. For 2026, it will also unchanged 43.6 million barrels per day, reflecting another increase of 0.6 million per day compared to 2026. So this concludes our today's analysis. Thank you for watching Energy Insights. We will see you in the very next episode.